Understanding the promissory note process in banking. This tutorial explains the typical process of how a promissory note functions in a banking context, focusing on its creation, use, and implications for borrowers and lenders. Below is a step-by-step breakdown. 1. The agreement. A promissory note is a financial instrument where a borrower agrees to repay a specific amount to a lender. In this scenario, the agreement clearly identifies borrower, the individual receiving the funds, e.g., Mr. Smith. Lender, the financial institution providing the loan. 2. Key terms in the agreement. The written agreement includes critical terms such as borrower, lender, loan, interest, credit, money. These terms define the responsibilities and obligations of each party. 3. Loan process. Borrower signs the note. The borrower agrees to repay the loan amount plus interest. Bank issues a check. The bank provides a check to the borrower, enabling the purchase of an asset, e.g., a house. Borrower receives funds. The borrower is obligated to repay the amount specified in the promissory note. 4. Ownership of the promissory note. The bank claims legal ownership of the promissory note, allowing it to enforce repayment. The promissory note is recorded as a bank asset and used to create a new matching liability or deposit. 5. Cash value and loan fulfillment. A promissory note has actual cash value equivalent to the loan amount. For the agreement to be fulfilled, the bank must loan an amount equal to the note's value, e.g., $200,000. If the bank does not provide this value, the borrower retains ownership of the note. 6. Funding the loan. The borrower's promissory note is treated as cash value by the bank. The bank uses this value to fund the loan check given back to the borrower. This transaction is often seen as a swap or exchange, not a traditional loan. Borrower provides cash value via the note. Bank returns the equivalent value as a loan check. 7. Federal Reserve policies. According to standard Federal Reserve banking practices, the promissory note is recorded as an asset. A matching liability or deposit is created. The bank issues a loan check from the new deposit. This process does not involve the bank using its own money or depositors' funds. 8. Tax implications. The bank does not pay taxes on the value received from the borrower, as it is treated as a deposit or loan. If a loan is forgiven, it becomes taxable income. 9. Borrower's perspective. The borrower's funds, from the promissory note, are essentially used to fund their own loan. The borrower repays the loan amount plus interest, even though the bank did not contribute its own funds to the transaction. 10. Key observations. The process highlights that the borrower provides the actual value that funds the transaction. The bank's role is to facilitate the process, not to provide its own money. Written agreements often do not explicitly disclose that the borrower's funds are used to finance the loan. Conclusion. This process demonstrates how promissory notes are structured and utilized within banking. Borrowers should be aware of the mechanics to fully understand their financial obligations and ensure transparency in the loan agreement.